essentially pick your poison, right? Are you going to pay your fat tax now and just, assume that something's going to happen? Or do you make the right decision now and be smart with your money? And then when it happens, then deal with it.
All right, Tom. So what other questions do you think someone might be asking? Or even when I have, potential clients call you to talk to you on the phone, what do you feel like comes up that you might want to mention here?
Yeah, again, I hit on it earlier. Who was Brett? Can I trust him? Which, that one I already vetted out. I do think because of the nature of it sounding too good to be true, I think it's important to talk about, yes, the track record, but has the IRS come to you with questions, or like, what do you see in that in terms of trending? Are they beginning to put a magnifying glass? I know there's a couple other people that are doing a DST, and frankly, when I've seen them out in the market, they seem a little scattered, and I'm getting a little worried that they're going to ruin the bucket of clean water for everyone else. But what are your thoughts on that?
Yeah, it's a great point. I mean, even recently there was one, it was an IRS, I guess, memo or released regarding a thing called a monetized installment sale, which often people either they put them in the same bucket or get them confused. And even our clients came to us like, oh my gosh, our CPA is saying this. And we're like, that's not us, right? And in fact, that's the opposite. Those types of structures are basically giving you all the money up front and say, do whatever you want with it for the most part. And it's still tax deferred, which we call that constructive receipt. So there's nuances to these strategies that are compliance based, right? Not just idea based, because I think the way that Campbell Law puts it is every tax deferral strategy works until it gets audited, right? And so over the years, the 27-year track record, every 3 to 5 years, there's another strategy that has its runway for a little while. And people go, oh, it's either cheaper or it gives me some extra benefit for flexibility, and maybe doesn't require the third-party trustee or whatever it might be, a little less expensive. But those all tend to blow up. And so I would say that's one of the biggest things to understand is that so far it's batting 1,000, meaning over 24 no change IRS audits, tens of thousands of tax returns over the years, thousands and thousands and thousands of assets that have been used it. But also there's a lifetime audit defense just in case, because every circumstance is different. In other words, Tom's unique circumstance with being in Texas, what he's selling, when he sold it, all of those things, it's like an individual, ACL surgery, right? Where somebody in California or New York or New Jersey or Florida, these are all individual fact patterns that it's just not a one size fits all template. But so far, it's following the IRC 453 guidelines and the third party unrelated trustee. And if we're following what's been built, it's batting 1,000. So that's the best thought. The other thing too would be there's also third parties beyond just us saying this. There's a private letter ruling. There's third party national law firms. There's one gentleman who was a potential client. His business ended up, the buyer backed out, but he was selling an $8 million business in Southern California. And he goes, Brett, this sounds really great, but you guys are all saying it. He goes, can I go find somebody separate and bring them to the table to vet this? We said, absolutely. Like, we're an open book as long as that person signs the non-disclosure. And he found a former IRS agent who's a tax attorney whose specialty is looking at tax deferral strategies to see if they would pass muster, right? They're legal. So that guy did about a 90-day due diligence, spent time with business partner Campbell Law, went through it all and gave a private legal opinion that was thumbs up. Right? And this is consistently what we see. But for those who don't have the time and or they need to trust, they want to really just put all of their trust and all of their confidence just in their CPA who hasn't heard of it before, that could be the challenge for people to overcome. But most of the time when we spend the time with that CPA, they join us and they bring us referrals. So any thoughts on that, Tom?
Yeah, I mean, it's like, I'll just say it's, essentially pick your poison, right? Are you going to pay your fat tax now and just, assume that something's going to happen? Or do you make the right decision now and be smart with your money? And then when it happens, then deal with it. And in that process, keep clean books, keep clean audit trails so that you're not spending hours doing that. That's my take. It's like, look, I am pretty adverse in really trying to avoid headaches. I've chosen the path that, my lawyers checked it out, said it was fine. My advisors on the tax side say it's fine. It is a unique instrument. To your point, the tax man's always trying to get more taxes. So eventually they might come and question things, but you don't forego smart moves now for the potential of what could be later.